Ready, because today we are diving deep into the stock market.
Oh, yeah.
We're talking about how to be a smart investor,
That's right.
someone who doesn't just throw darts at a board full of company names hoping something sticks.
No more blindly picking stocks.
And you definitely don't need to read a whole textbook to become an investing whiz.
Absolutely not.
And that is where we come in.
We've got you covered.
You gave us this podcast episode all about analyzing stocks.
Right.
And we're going to break it all down, make it crystal clear.
Love it. Let's do it.
So this podcast we're dissecting today had this really cool point right at the start.
Okay.
It basically said that investing in a company, it's kind of like becoming a mini business owner yourself.
Exactly. You're not just gambling on a hunch, you're buying into a business.
Okay, so it's about understanding the business, not just blindly throwing money around.
Precisely.
That makes a lot of sense because, okay, I get Apple.
Sure.
I use their products, their stores are everywhere. But some of these other companies out there,
Yeah.
it's not so clear what they even do.
It's easy to feel lost.
So I love that this podcast really zeroed in on this question. What does this company actually do?
It all begins there. Understanding the business model. How do they actually generate revenue?
Yeah, what's their bread and butter?
Exactly.
And not just one type of bread either. This podcast used this really helpful analogy about a restaurant that only had one dish on the menu.
Oh, I see where you're going with this.
Yeah.
Risky move, right?
Very risky.
If that one dish falls out of favor.
Yeah, then what are you left with?
Exactly. Revenue's gone.
It's like a music artist who only have one hit single, here today, gone tomorrow. That's it, you're done.
That's a great analogy.
That's the problem with a company relying on just one product.
Diversification is key, having your hands in multiple different things. Multiple products or services, different markets, it spreads the risk.
Okay, so diversified revenue streams, that's what we're looking for.
Absolutely.
So we kind of get a handle on what the business actually does.
Right.
But then we get to the part that always makes my eyes glaze over a bit.
I know what's coming.
The numbers.
The dreaded number.
The financials.
Yeah, but don't worry, we're not turning this into a boring accounting lecture.
Thank goodness.
We'll keep it practical.
Okay, good, because we definitely need to understand at least the basics of what these financial statements are telling us, right?
Think of it like the language of business. Got to learn the lingo.
Okay, we need a crash course in business then. And luckily,
Here we are.
we've got our resident expert right here to walk us through it.
I'm happy to help.
So we've got the income statement, the balance sheet, and the cash flow statement.
The big three.
The podcast does a pretty decent job explaining them, but what are the most crucial things to take away, especially for someone who's just getting started?
Great question. So let's start with the income statement.
Okay,
This one shows us how profitable the company is.
makes sense.
You'll hear people talk about the top line and the bottom line.
Oh yes, I'm a visual learner. I like that.
Exactly.
So the top line is all the money coming in.
Revenue.
And then at the bottom, after all the expenses, what's left over, that's the profit.
You got it. That bottom line is the net income.
Oh, net income. Okay.
And that actually ties directly into your own personal finances, believe it or not.
Really? Tell me more. How so?
Think about it. Would you rather have a huge income, but your expenses are even bigger?
Okay. Yeah.
Or would you prefer a moderate income, but you've got money left over every month to invest?
Oh, money left over to invest is always a good thing.
Exactly. That's what we're looking for in a company's income statement, too.
So we want that company to be in the black. Is that what they call it?
That's the term, exactly.
Okay. All right. So income statement. Got it. What about the balance sheet? That one always seems a little trickier.
The balance sheet, it's like a snapshot in time.
Okay.
A financial selfie of the company at a specific moment.
A financial selfie. Okay. I like that.
It shows what the company owns. Those are its assets.
Assets. Okay.
And then what it owes, its liabilities, kind of like debts.
Okay. So assets are good. Liabilities, not so much.
You want to see more assets than liabilities? It shows they're in a good place financially.
Gotcha. So if the income statement is like watching a movie of the company's performance over time,
I like that analogy.
the balance sheet is like a quick snapshot, a selfie.
Exactly.
Okay, last but not least, we've got the cash flow statement. Now, this one always seems a little mysterious to me
This one's all about the actual flow of cash in and out of the company.
because even a company that's profitable on paper can still mismanage its cash, right?
Absolutely. Cash flow is king, and the statement tells you how well they're managing their kingdom's treasury.
It's like that friend we all have who makes a good salary but can never seem to manage their money.
Exactly.
Okay,
So,
cash is king. Cash is king. That's what we learned.
you got to watch that cash flow.
But it's not just about the numbers, right? Because this podcast you sent, it also made this point about the people running the show, the actual management team.
Oh, absolutely. Numbers are crucial.
Yeah,
But the human factor is huge.
totally, because, I mean,
A company can have a fantastic product,
yeah,
but with the wrong leadership, it can go downhill so fast.
it's like that saying, people don't leave companies, they leave managers.
That's so true.
So how do
A
we...
bad manager can really ruin it.
They can ruin it.
Yeah.
So how do we as investors, how are we supposed to be like sizing up this leadership team, especially if we don't know anything about them?
Yeah, so the podcast talked about looking at the CEO's track record.
Okay.
Have they led other companies?
What's like checking their resume?
Yeah, basically.
Their business resume.
Business resume, exactly.
To see, like, have they been successful before?
Right. What's their track record like? But it's not just about past performance either.
Okay.
This podcast really hammered home the concept of skin in the game.
Okay, so I've heard that phrase before.
Yeah.
What does that actually mean when we're talking about investing?
So it means, do the executives, the people making the decisions, do they actually own stock in the company themselves?
Oh, so they're not just employees. They actually own a piece of the pie.
Exactly.
So they're invested in whether this company succeeds or not.
Exactly. Their incentives are aligned with yours as a shareholder.
They're not just going to jump ship if something goes wrong.
Exactly.
They're in it for the long haul, hopefully.
Ideally, yes.
Okay, so we've looked at the company itself. We kind of get it. We understand their financials. We've checked out the management team. But then this podcast also made a really good point about not ignoring the bigger picture, right?
Absolutely. It's not just about the company in isolation. You have to look at the industry they're in, the overall economic environment. It all matters.
It's like, even if you have a really strong, healthy fish, if you throw it in a polluted pond, it's not going to do so well.
Perfect analogy.
So even a great company can get dragged down if the industry isn't doing well.
Exactly.
Or if the whole economy is tanking, right?
That's right. It's like that saying, a rising tide lifts all boats.
Okay, so we need to be paying attention to these bigger trends. So is the industry growing? Is it shrinking? Are there any like big changes happening?
Yeah. Are there any technological disruptions on the horizon?
Ooh, disruptions. That's a good word.
Things that could shake things up. All those things can really impact the company no matter how great their product is.
So we need to be like mini economists now, too, on top of everything else.
You don't have to get a PhD or anything, but
Okay.
just a basic understanding of how things work. The podcast mentioned things like interest rates, inflation, consumer confidence.
Okay, yeah, those are all things I've heard of. But how do those actually impact a potential investment?
So let's take interest rates, for example. If interest rates are low, it's cheaper for companies to borrow money.
Makes sense.
They can invest in growth, expand their business. That's good for us as investors, right? But when those interest rates rise,
Oh, here comes the bad news.
borrowing becomes more expensive. It can hinder growth, put a damper on things.
Okay, so higher interest rates could mean less investment, slower growth.
Potentially, yeah, it's all connected.
Everything's tied together.
And that podcast, it actually explains those connections really well.
Okay, so we understand the business, we're getting a handle on the financials, we know to check out the management team, and we're keeping an eye on the bigger economic picture.
You're becoming quite the savvy investor.
But now for the real question, like the million-dollar question,
Yeah,
literally,
shoot me with it.
how do we know if we're actually getting a good deal on this stock?
That's where valuation comes in.
Valuation, okay.
A company might be fantastic,
Yeah,
but that doesn't mean its stock is a good buy at any price.
right, because I love my local coffee shop, but I'm not going to pay $1 million for it,
Exactly.
even though their coffee is amazing.
Right. So we need to figure out, is the price right for this company? And that's where those valuation ratios come in.
Valuation ratios, okay.
Yeah, they help us compare the stock price to the company's earnings, its sales, other important metrics.
Okay.
The podcast mentioned a couple of important ones. Price to earnings ratio,
Okay.
or PE ratio. You'll hear it called both ways.
PE ratio, I've heard of that.
And then there's the price to book ratio,
Price to book?
or PEB ratio.
Okay, those sound familiar, but can you refresh my memory on what those actually tell us?
Absolutely. So the PE ratio, it tells us how much investors are willing to pay for each dollar of the company's earnings.
Okay.
So a higher PE ratio
Yeah.
could mean investors are really optimistic about the company's future growth.
So they're willing to pay a premium because they think those earnings are just going to go up and up.
That's the hope, right?
All right.
Now, the PB ratio, it's a little different. That one compares the market value of the company to its book value. Basically, it's net worth.
Okay, so if that market value is way higher than the book value, does that mean like investors are super optimistic about this company? Like they think it's worth way more than what's on paper?
You got it. They see potential beyond those tangible assets. They think those assets are going to generate big earnings down the line.
They're seeing into the future?
They're trying to, at least
Okay,
crystal ball's a little fuzzy sometimes,
that's fair.
but that's the general idea.
Okay, so PE ratio, price to book ratio. But I remember this podcast made a point of saying that looking at those ratios all by themselves isn't actually enough, right?
You're catching on. You can't just look at those numbers in isolation.
Okay.
We need to compare them to other companies in the same industry.
So context is everything.
Exactly.
The high PE ratio might be normal in one industry, but a red flag in another.
Precisely. It's all relative.
Okay, this is great. But my brain is starting to hurt just a little bit.
I hear you. It's a lot of info.
It's a lot to keep track of. Business models, financial statements, the management team, these industry trends.
Yeah.
Is there a way to, like, bring it all together in a way that makes sense?
That's where the SWOT analysis comes in.
SWOT analysis.
This was another gem from the podcast. Really helpful tool to kind of summarize all that information we've been talking about.
Okay, SWOT? SWOT? That sounds familiar. I remember learning that in somewhere. Can you give us a quick refresher on what that stands for?
Sure. So SWOT stands for strength, weaknesses, opportunities, and threats.
Okay.
It's like a report card for a company.
I like that. Okay, company report card. I'm listening.
Gives you a concise way to assess where they stand overall.
Okay, so the strengths and weaknesses, those are internal to the company, right? Like their strengths might be they have a really strong brand, but maybe a weakness is they rely too much on one particular supplier, something like
You
that.
got it. And then opportunities and threats, those are more external factors. Things like, are there new markets they could expand into?
Oh, opportunity.
Exactly. Or on the flip side, are there new competitors popping up that could threaten their market share?
Okay, so like new technology.
Exactly. Things
Yeah.
like that.
This is really helpful because now I'm thinking about companies that I know and what would their SWOT analysis look like? This is good. Okay, SWOT analysis, company report card, I love it.
It's a good one, right?
But even when we've got all this information, all this data,
yeah.
this podcast, it kind of reminded us that the market,
Yeah.
it doesn't always behave rationally, does it?
You're talking about market sentiment, right? How news and hype can really move those prices around.
Exactly. And it's not always like based on logic.
Sometimes it feels like the market's just got a mind of its own.
It totally does. Like one little tweet
Oh, I know.
can send things through the roof or like crashing down,
It's crazy.
even if like fundamentally the company's doing fine.
That's why you got to stay focused on the fundamentals,
Right.
all that stuff we've been talking about.
Not get too caught up in the hype.
Exactly. Don't let your emotions drive your decisions.
Okay, so don't try to time the market, right?
Time in the market, that's the saying.
I'm in the market, there we go.
Yeah.
But even when we've done all our homework,
Yeah,
we found a company we love, we believe in it for the long term.
right.
There's always that chance that,
Things could go south.
things could go wrong. So how do we manage that risk?
That's where risk management comes in.
Okay, risk management.
Got to be smart about it.
Because I don't want to be losing sleep at night, stressing about my investments.
Nobody wants that, right? So remember that old saying,
What's that?
don't put all your eggs in one basket.
Oh, diversification, yeah.
Classic advice.
But it's easy to forget.
It is, especially when you get excited about a particular company.
Yeah, you're like, this is it. This is the one.
You fall in love a little bit.
You fall in love, you're like, oh, my money's going in.
But that's when you got to take a step back and remember diversification.
Spread the love around.
Exactly. It's like you wouldn't go to the horse races and bet everything on one horse, would you?
No way. Not all my money on one horse.
Even if you were really confident.
No, I'd spread it around, hedge my bets.
Exactly. That's diversification.
Okay.
So you're not putting all your hoops into one company, no matter how promising it seems.
So if one of your investments doesn't do so well,
Right.
it doesn't tank your whole portfolio.
Exactly. You've got that cushion, that safety net.
I like it.
It's all about managing that downside risk.
Okay, diversification, got it.
Mhm.
What else? What were some of those other risk management tips?
The podcast also talked about position sizing. Remember that one?
Position sizing. Remind me.
That's about deciding how much of your total capital, your investment money,
Okay.
how much are you actually comfortable putting into any one investment?
Oh, so don't bet the farm on one company,
Exactly.
even if you think it's a sure thing.
It's about finding that balance between risk and potential reward.
Risk and reward, two sides of the same coin.
That's investing in a nutshell.
Wow, I feel like we've covered so much ground today.
We really have.
This deep dive has been amazing. We went from like, what even is a stock?
No.
To actually feeling like we can analyze a company like pros.
You're well on your way.
This is great. I feel very empowered.
Knowledge is power, that's what they say.
It's true, especially in the world of investing. So we've got our roadmap, we've got our tools.
You've got this.
Time to put it all into practice. This is fantastic. Thank you so much for breaking all this down with me.
Anytime, happy to help.
And for everyone listening, keep learning, keep that curiosity going, and happy investing.